Higher rates environment and a higher cost of capital, has that cooled down momentum in your space?
Yeah, look, I think, generally speaking, we would say infrastructure is somewhat resilient to higher debt costs because of the inflation-protected nature of certain cash flows. So oftentimes when you have those contracts, you can have inflation adjustments that help protect against some of those higher debt costs or even regulatory resets in your revenue line. That being said, it is something we're keeping an eye on where, you are seeing those higher debt costs combined with the higher construction costs to build new assets or greenfield projects, as we call them. And therefore, you might see equity sponsors, the owners of these projects, have to put in more equity, which could compress equity returns.
The other trend that we've seen in this region is nearshoring and the distribution or the redistribution of the supply chain, and that really benefiting Southeast Asia. I'm thinking about Malaysia and Penang and Vietnam, the big beneficiary. Is that an area that you're keen on?
Yeah, absolutely. When it comes to some of those themes, the realignment of supply chains is something we're studying very closely and see is creating new investment opportunities, whether it's in Southeast Asia, but also onshore in North America. When you think about short line railroads, some of the logistic assets, and even into the real estate sector around industrial assets, we think these are all areas and trends that we're watching and looking and investing behind.
And then there's digital infrastructure, cloud and AI, data centers. That's very much the 21st century aspect of infrastructure in this region, if not globally. But I've got to say, there's quite a lot of competition for those kind of assets. You've got private equity, VC trying to get in on the game as well, driving up valuations.
Which kind of begs the question.
How do you play in that sandbox?
Yeah, I was going to say, it begs the question, right? It's been a pretty tough 12, maybe 24 months at the least for private equity, right? And rates, we had that blowout jobs report on Friday. Looks like, hey, even if they're going to pause, it's going to be maybe for longer, maybe a lot longer than we think. For an industry like infrastructure and private money in infrastructure, that's, you look at both those things together and you go, look, infrastructure is already a long cycle business. With rates, if they're going to stay high, wow. In terms of an exit, are they going to have to hold their, don't hold your breath or what?
Yeah, look, I think there's still a tremendous amount of investor interest in this asset class. When you look at the trends from private institutional investors, they've been under-allocated to this sector globally. And so you see a lot of capital that has continued to come into this asset class interested in it. And so you have that, as I like to call it, that wall of capital that's very interested in gaining exposure to this defensive asset class that will create some liquidity for the private markets. But it is going to be a balance. And I think ultimately the specific project economics and underlying fundamentals are going to be critical to each asset.
Yeah, I have to add, it's only going to work as a long cycle business in markets that are regulated, yes?
Yeah, look, I think regulatory risk is something we're keen to understand and analyze before any investment. And that regulatory risk can be both positive and negative. You take the Inflation Reduction Act in America, obviously hugely beneficial to the clean energy transition. And so that's something we're very focused on in our home market of the U.S. But understanding that regulatory risk is pivotal.